They called it irrational exuberance. A fever dream of endless wealth. A promise that this time would be different. 3 centuries, 4 continents, countless lives shattered. They lost their homes, their families, their millions. But worst of all, they lost hope. This is the story of financial bubbles, the greatest wealth transfer mechanism ever created. You'll see how one bulb cost more than a house, how a shoeshine man gave stock tips before the Wall Street crash, how millions of people believed in internet fantasies and lost everything, and how the dream of owning their own home turned into a worldwide disaster. These are not just stories, they are warnings that we're once again ignoring. Before we begin, if you're wondering why some people lose everything while others get rich off fraud, if you want to understand how real money works and why stories like this one keep happening over and over again, subscribe. It's not just a video, it's a reminder that everything that seems new has actually already happened. Tulip Mania, the first big bubble. Every bubble follows the same pattern. Every collapse leaves behind the same wreckage. And each time we convince ourselves that it won't happen again, but it is, always. Amsterdam, 1636. Imagine that one flower bulb is worth more than your house. More than 6 years of the average worker's salary for a flower that will bloom for a week and then wither and die. The tulip arrived in the Netherlands from the Ottoman Empire in the late 16th century. Exotic, colorful, unlike anything Europeans had seen before. Soon, rich people began collecting rare varieties as status symbols. But something has changed. The pursuit of beauty has turned into the pursuit of profit. Johann van Gold, a wealthy merchant, recalls in his diary, "People buy what they can see, and tomorrow they will sell what they don't have." By 1636, tulip bulbs were being sold in exchanges in taverns throughout Holland. The fever had spread. Greed, pure and simple. But also fear of missing out. A primal desire not to be left behind while others moved up. Farmers sold their lands to buy bulbs. Merchants abandoned their trades. Ordinary people, bakers, carpenters, masons, mortgaged their homes to speculate on flowers. Then came February 3rd, 1637. The usual auction of tulips in Haarlem, at which for the first time no one showed up to buy. By morning, panic had set in. Bulbs once worth fortunes could not be sold for nothing. Contracts had been broken. Debts remained unpaid. Lives crumbled like houses of cards. The Dutch government's response? They offered to settle the contracts at 10% of their face value and declared that the debts for the tulips were gambling debts, unenforceable by law. The message was clear. You're on your own. 400 years later, we still use the term tulipomania to describe irrational market behavior. However, we still haven't heard the most important lesson. When everyone thinks something is valuable just because others think it is valuable, the foundation is only built on air. The Great Crash of 1929. The Roaring Twenties. America was changing. Automobiles, radios, talking pictures, electricity was transforming homes. The future had arrived, and Wall Street was its cathedral. Between 1920 and 1929, the Dow Jones Industrial Average rose 600%. The middle class invested their savings in stock for the first time. Cab drivers discussed portfolio theory. Shoe shiners gave stock tips. And the banks? They were happy to help by offering loans to buy stock. By 1929, you could buy $100 worth of stock by depositing just $10. The other 90%? Borrowed money. Stocks have reached what looks like a permanent high plateau. Those words, spoken by economist Irving Fisher on October 15, 1929, would haunt him forever. Just 9 days later, the unimaginable happened. On Thursday, October 24, 1929, Black Thursday, the market fell 11%. Panic selling began. 4 days later, on Black Monday, it fell another 13%. The next day, on Black Tuesday, it was down another 12%. The ticker could not keep up with the collapse. Entire fortunes disappeared in a matter of hours. Within a month, the market lost 40% of its value. By 1932, stocks were down 89% from their peak. The bright noise of the 20s dissolved into the silence of the Great Depression. The losses were catastrophic. By 1933, 1 in 4 Americans was unemployed. Suicide rates rose. Thousands of banks failed, taking people's savings with them. Bread lines stretched into whole neighborhoods. Hoovervilles sprang up all over America. William Crawford, a former banker who lost everything, left only a note before jumping out of his office window. "My sin was that I believed America could not fail." John Maynard Keynes would later write, "Markets can remain irrational longer than you can remain solvent." The collapse exposed a fundamental truth. Speculation built on debts creates a house of cards. When trust breaks down, the collapse becomes not financial, but civilizational. To modern investors trading on smartphones with borrowed money, this story may seem painfully familiar. If you're one of them, here is a reason to think about it. Dot-com bubble. The new economics. Words that justify abandoning all lessons in the history of finance. It was the late 1990s. The internet was changing everything. Amazon, eBay, Yahoo, companies with no profits and sometimes no revenue at all were going public at astronomical valuations through initial public offerings, IPOs. From 1995 to 2000, the Nasdaq index rose 400%. Internet companies added .com to their names and watched their stock prices triple overnight. Alan Greenspan, chairman of the Federal Reserve, warned of irrational exuberance in 1996 and then seems to have fallen victim to it himself as the bubble continued to inflate. Traditional indicators, profit, assets, revenue, were discarded as quaint relics of the old economy. New metrics emerged: website traffic, eyeballs, burn rate. The narrative was intoxicating. Get in the game early, the internet will change everything. FOMO, fear of missing out, reached a fever pitch. Millions of ordinary people invested in tech stocks, often with little understanding of what they were about, but confident that they were buying a slice of an inevitable future. Pets.com spent millions on Super Bowl commercials featuring a sock puppet while losing money on every sale. Their slogan? Because pets can't drive. Webvan raised $800 million to deliver food over the internet and went bankrupt 2 years later. Cosmo.com promised hourly delivery of anything from movies to ice cream with no minimum order and no delivery fees. Before collapsing, they burned through $280 million. The fantasy ended in March 2000. The Nasdaq peaked at 5,048 and then began its long decline. By October 2002, it was down 78%. Trillions of dollars in market value have evaporated. Layoffs have swept through the technology sector. Pension funds invested in tech stocks have suffered huge losses. Dreams of digital riches turned to dust. Many who thought they were investing in innovation found they were just gambling. The pain was real, and the losses devastating for countless people who believed in the promises. The dot-com bubble showed how quickly we turn technological innovation into financial speculation. A lesson we have again forgotten is being repeated today with cryptocurrencies and artificial intelligence stocks just some 20 years later. And we continue the story of humanity's biggest financial failures of the last centuries. The 2008 housing crisis, when houses turned to bubble. I've been doing this for 30 years and I've never seen a more perfect storm. That's what Richard Kovacevic, CEO of Wells Fargo, said when the 2008 financial crisis hit. But that storm was not natural, it was man-made. Now the illusion was no longer tulips or tech stocks, but something seemingly tangible, safe, like, well, houses. The foundation of the American dream. Interest rates were low after the dot-com crash. Housing seemed like a safe investment. After all, home prices in the country hadn't fallen since the Great Depression. Banks created new financial instruments such as mortgage-backed securities, MBS, and collateralized debt obligations, CDOs. were assigned deceptively safe ratings and sold to investors around the world. The innovation that turned the housing boom into a global disaster: subprime mortgages. Lenders offered ninja loans. No income, no job, no assets. Interest-only loans. Negative amortization loans, where the principal actually grew over time. Adjustable rate mortgages were teaser rates that skyrocketed after 2 years. It was a house of cards built on a shaky foundation. Everyone seemed to be profiting, lenders making risky loans, investment banks packaging and selling them, rating agencies blessing them, homebuyers reselling real estate. Greed permeated the entire system. Warnings about the inevitable consequences of lending money to people who couldn't afford to pay it back were ignored. As Warren Buffett aptly put it, it's only when the tide goes out that you discover who swam naked. In 2007, the tide turned. Home prices peaked and then began to fall. Adjustable rate mortgages went to zero. Suddenly, millions of people found themselves unable to make payments or sell their homes. By September 2008, Lehman Brothers collapsed, the largest bankruptcy in American history. The global financial system came to a standstill. It wasn't just Wall Street, but Main Street, London, Tokyo, everywhere. Then came the Great Recession. Between 2007 and 2010, more than 8 million Americans lost their jobs. About 10 million lost their homes. Retirement accounts lost $2.4 trillion. The very institutions that created the crisis received a $700 billion bailout from taxpayers. Many executives who sold toxic securities received bonuses that same year. As Mark Baum's character in the movie The Big Score would say, they don't admit it, they're bragging. The 2008 crisis revealed banking's worst-kept secrets. Profits are privatized, losses are socialized. When banks win, they keep the money. When they lose catastrophically, taxpayers foot the bill. It was the ultimate, most poignant lesson. And the question hangs in the air: did we absorb its meaning? Imprisonment, patterns, and prevention. Tulips, stocks, dot-coms, houses. Assets change, ages change, technology evolves. But the script remains eerily familiar. It begins with a compelling narrative, a new era, a revolutionary technology, an asset that can only grow. Easy credit is fueling the fire. Greed and FOMO draw crowds, drowning out caution. Valuations are disconnected from reality. Experts declare that this time it's different. And then the inevitable violent correction. It's tempting to blame faceless institutions or complex algorithms, but the inconvenient truth lies closer to home, within ourselves. Our innate susceptibility to herd behavior. History doesn't repeat itself exactly, but it does rhyme, often tragically. If we forget these lessons, blinded by the next seductive narrative, the next wave of irrational exuberance, we will repeat them. Memory isn't just history, it's survival. Stay tuned. Subscribe to dive deeper into the world of big money, power dynamics, and the psychological forces that determine our financial destiny. Share your thoughts in the comments. What patterns are you seeing today? Where do you think the next danger lies?